The iShares World Equity High Income is incorporated in Ireland and authorized by the Central Bank of Ireland. The Irish domicile provides a regulatory environment that adheres to the Undertakings for Collective Investment in Transferable Securities (UCITS) standards, which govern diversification, liquidity, and use of derivatives. As an actively managed vehicle, WINC departs from the replication of a benchmark, granting the investment manager the discretion to select securities and adjust weights based on proprietary quantitative models. While the fund utilizes the MSCI World Index as its comparator benchmark for performance measurement and risk management, the management team is not bound by the index's components or weightings. The fund's specifications include management fee/TER 0.35% per annum, asset class, global developed equity, distribution policy, distributing quarterly.
As of March 2026, the fund's assets under management for the distributing share class reached approximately €223 million. WINC's investment strategy is a two-pronged approach designed to maximize the yield-to-volatility ratio of the portfolio. The first component involves the systematic selection of high-quality dividend-paying stocks, while the second employs an options overlay to harvest additional premiums, thereby augmenting the natural yield of the equity basket. The systematic stock selection process begins with a broad universe of developed market equities. Unlike traditional dividend ETFs that may simply track a high-yield index, the WINC model evaluates companies based on their ability to maintain or grow dividend payouts, their fundamental size, and their trading liquidity. The management team applies a dividend rotation strategy, which integrates proprietary investment insights to identify companies with superior dividend sustainability and capital appreciation potential. By controlling for style and sector biases, the fund seeks to offer diversified sources of income and growth while avoiding common value traps, where high yields are merely a reflection of declining share prices or deteriorating fundamentals. The model is dynamic, adapting to shifting market conditions to ensure the active risk taken by the fund remains appropriate for its objective of lower volatility relative to the MSCI World Index. To generate high current income beyond what is achievable through dividends alone, WINC pursues an investment strategy using derivatives. Specifically, the fund aims to generate additional income by selling, writing, call options, and buying futures on developed market large and mid-capitalization indices. The mechanics of this covered call or buy-write strategy at the index level involve several key technical nuances. Premium collection. By selling call options, the fund receives an immediate premium, cash. This premium is the primary driver of the fund's high distribution yield, which significantly exceeds the yield of the MSCI World benchmark. Capped upside. In exchange for the premium, the fund agrees to cap its potential gains if the underlying index rises above the strike price of the sold options. This is a critical trade-off. The fund accepts limited participation in bull markets to secure immediate cash flow. Volatility dampening. The collected premiums provide a modest buffer during market declines. While they do not protect the fund from major losses, they offset a portion of the price decline, effectively reducing the fund's overall volatility and lowering its beta relative to the broader market. One distinctive feature of WINC is its use of index-based derivatives rather than individual stock options. Index options, such as those on the S&P 500 or MSCI World, are typically European style, cannot be exercised before expiration, and cash settled, which simplifies portfolio management and reduces the transaction costs associated with managing hundreds of individual equity option positions. Furthermore, index options allow the fund to capture volatility risk premium, the tendency for implied volatility to exceed realized volatility, more efficiently across a diversified basket.
As of early 2026, the WINC portfolio is diversified across approximately 438 to 452 holdings. This breadth is characteristic of systematic management, as it aims to capture small edges across a wide array of positions rather than relying on concentrated discretionary bets. Despite its mandate for high income, WINC maintains a significant weighting in the information technology sector. The inclusion of technology at roughly 23% allows the fund to capture secular growth trends while utilizing the options overlay on tech-heavy indices to convert that growth potential into current income. This approach differentiates WINC from traditional value or dividend funds. WINC's geographic exposure is primarily concentrated in the United States, followed by other major developed economies. However, the fund's global mandate proved particularly beneficial in 2025 when non-U.S. markets outperformed the S&P 500 for the first time in several years in dollar terms. The fund's geographic distribution as of early 2026 is United States 65.05%, Japan 6.85%, Germany 3.78%, United Kingdom 2.12%, other developed markets 22.20%. As of March 2026, the top 10 holdings are cash collateral USD MILFT 7.45%, Nvidia 4.73%, BlackRock ICS US Treasury Agency 4.32%, Apple 3.59%, Microsoft Corp 3.06%, Alphabet Class C 2.01%, Meta Platforms Class A 1.53%, Broadcom 1.34%, Procter & Gamble 1.15%, Amazon 1.10%. A significant portion of the fund, over 11% combined, is held in cash collateral and treasury agency funds. This liquidity is essential for meeting margin requirements for the futures and short call positions, ensuring the fund can maintain its active derivative strategy without being forced to liquidate equity positions during periods of high volatility.
Risk and volatility metrics. A primary goal of WINC is to provide capital growth with lower volatility than developed market equities. Statistical data for the period ending March 2026 confirms this objective. Comparing the fund to the MSCI World Benchmark, annualized volatility 1 year, WINC recorded 13.33% compared to 14.99% for the benchmark. Return per risk, Sharpe-like, WINC measured 1.10 versus 0.74 for the benchmark. Beta versus market, WINC maintains a beta of 0.72 compared to the benchmark's 1.00. Max drawdown, 1 year, WINC's maximum drawdown was negative 12.82%, shallower than the benchmark's negative 14.04%. With a beta of 0.72 and a significantly higher return per risk than the broad market, WINC has effectively provided investors with a smoother ride. The fund's maximum drawdown was also shallower than the indexes, confirming its defensive characteristics during the high volatility periods of late 2025. Dividend policy and yield sustainability. The core value proposition for WINC investors is its distribution yield, which has consistently ranked among the highest in the UCITS equity space, fluctuating between 9.15% and 9.5%. Quarterly payout history. Dividends are distributed quarterly, usually in the months of January, April, July, and October. The total payout for the full year 2025 reached $0.5348 per share, an increase over the partial year in 2024. This yield is generated from two primary channels, the underlying portfolio's dividend income and the premiums harvested from the call writing strategy.
A common risk for high-income covered call ETFs is NAV erosion, where the fund pays out more in distributions than it actually earns in premiums and dividends, effectively returning investors' own principal as income. This reduces the fund's capital base over time, leading to lower premium generation and a declining share price. To evaluate WINC's sustainability, one must compare its NAV price growth to its distributions. From its launch to early 2026, WINC's achieved a total gain of approximately 15.53%, with a positive price growth CAGR of 4.79%. This indicates that WINC's has grown its principal while simultaneously paying out its high yield, a sign that the current distribution level is supported by legitimate investment returns and systematic alpha rather than capital depletion. While WINC's offers an attractive outcome-based strategy, investors must recognize the specific risks associated with its active derivative-heavy mandate. These risks are categorized into strategy-specific, technical, and market-level factors.
Capital growth and upside limitation risk. The fund's primary risk is the opportunity cost of capped upside. Because WINC sells call options, it trades away the potential for significant capital appreciation in exchange for immediate income. In a sharply rising market, a melt-up, WINC will almost certainly underperform the MSCI World Index. The fund's objective is to provide lower volatility, which inherently means participating less in the extreme peaks of a bull market. 2. Systematic model and quantitative risks. As an actively managed fund using quantitative models, WINC is subject to model risk. Systematic models are based on historical data and statistical relationships. If market dynamics shift in a way that the model does not anticipate, such as a fundamental change in interest rate sensitivity or sector correlations, the model may become inefficient. A quantitative approach is only as good as the data and assumptions behind it. Under extreme market stress, these models can fail to perform as expected. 3. Derivative and counterparty risks. The use of derivatives introduces special risks. While index-based derivatives are highly liquid, they still expose the fund to the credit risk of the clearinghouse or institutional counterparty involved in the trade. Furthermore, the complexity of derivative overlays can lead to contagion or spillover risk between different share classes of the fund, particularly for currency-hedged versions that use different sets of forward contracts.
4. ESG screening and performance impact. The fund's Article 8 classification requires the exclusion of certain sectors or companies that do not meet ESG criteria. Such screening reduces the potential investment universe and may adversely affect the value of the fund's investments compared to a fund without these exclusions. For example, if the energy or defense sectors, often targeted by ESG screens, experience a massive rally, WINC may be forced to sit out those gains, leading to underperformance relative to its unscreened benchmark. 5. Liquidity and operational risks. With an AUM of roughly €223 million for its main distributing class, WINC is a mid-sized ETF. In periods of extreme market stress, liquidity in the secondary market, the exchange, may dry up, leading to wider bid-ask spreads and potentially forcing investors to sell at a significant discount to the fund's NAV. Furthermore, the fund has a total expense ratio, TER, of 0.35%, which is higher than low-cost passive trackers, 0.07% to 0.2%, creating a higher hurdle rate that the managers must clear to provide net of fee alpha. Competitive comparison, WINC versus JEPG. WINC's most direct competitor in the European active income space is the JP Morgan Global Equity Premium Income, ticker JEPG. Key points of comparison include strategy type. WINC uses a systematic quantitative approach, while JEPG relies on discretionary active management. Distribution yield. WINC's yield ranges between 9.38% and 9.5%, which is higher than JEPG's yield of 7.34% to 7.9%. Assets, AUM. WINC has approximately $250 million in assets, while JEPG is significantly larger at roughly $1.38 billion. SFDR category. WINC is an Article 8 fund with an ESG focus. JEPG does not have a primary ESG focus. Derivative style. WINC uses index call options, while JEPG utilizes equity-linked notes.
JEPG is currently the market leader by size and offers the convenience of monthly payouts. However, WINC has differentiated itself on its reliance on scientific active equity models, which some investors find more robust than the discretionary manager approach of JEPG. Performance data from late 2025 and early 2026 suggests that WINC's systematic stock selection and index call strategy outpaced JEPG's total return in several windows, largely due to WINC's capture of the international global rally outside the US. Conclusion. The iShares World Equity has navigated its first 2 years of existence, proving that a systematic, derivative-enhanced strategy can deliver high income without suffering from the NAV erosion that plagues many of its peers. For income investors, WINC is a choice for retirees or those seeking consistent cash flow from their equity holdings. Its 9% yield is well supported by current market volatility and the team's stock selection alpha. For defensive portfolios, the fund's beta of 0.72 and its focus on lower volatility makes it a choice for conservative portfolios that want equity participation but need a smoother ride than what is offered by the standard MSCI World. For growth portfolios, WINC is likely inappropriate for younger investors with long-term horizons, 20-plus years, who can tolerate volatility. The capped upside of the covered call strategy will likely lead to significantly lower total wealth over time compared to a standard non-distributing global index fund.